Hello and a very warm welcome to everyone. I am Shrija Agrawal and you are watching the Mint Special on decoding private credit in India. We have a pretty meaningful panel here, but before we delve deeper into this, it's time for some context setting. As India's pandemic battered businesses and economy emerges into a still uncertain next normal, there is an increasing focus on private credit as a fuel to drive business expansion and sustainable long term growth. This, as the traditional lenders such as banks, especially PSU banks, which have done yeoman service for the country during the difficult days of 2020, will be facing greater pressures in 2021 and beyond as NPAs will challenge their bottom lines. NBFCs, too, have been facing their own share of challenges over the past 2 years, as is well known given the lending support that Indian businesses need to hold their own against both domestic and international competition, including export markets, as well as their need to innovate and expand in the fast changing technological and customer landscape, the role of private credit is key. In fact, private credit is the fastest growing alternative asset class in the world and has been for the last 4 to 5 years. Evolved since the 2009 global financial crisis, lots of debt capital has been flowing through asset managers rather than banks. Today, over $1 trillion in size. Bank lending is shrinking on account of all the increased regulations, the ability of independent asset managers to up this share vacated by banks is the trend globally. Post ILFS crisis and the continued bank NPA crisis, credit in India has become a huge need for growing companies as well as troubled companies. NBFCs are vacating that space and alternative asset managers are entering that. Private credit as an asset class is still scaling up on a relatively small base in India. India is about a $3 trillion economy and growing at 6 to 7% real growth rate. It is a critical market of size and huge growth potential. The presence of credit bureaus in India, as compared to other markets, will really enhance the use and deepening of private credit. Also, there's a large opportunity to invest over 25 to $100 billion over the next 4 to 5 years, and that could potentially grow to be larger than the private equity industry. The fact that there's some $290 billion of dry powder of private credit available highlights the opportunity for the Indian economy and a catalyst for opening up endless possibilities for Indian businesses as they navigate the next turbulent next normal. To discuss this, I'm very happy to introduce a panel of brilliant professional practitioners in the private credit space. Please help me welcome Neeraj Seth, Managing Director, Head of Asian Credit at BlackRock, Ashish Goyal, Senior Managing Director, OMERS, Eric Vimont, Managing Partner and Head of Strategy at ARESSSG, and Shyam Maheshwari, Partner SSG. Gentlemen, it's my sheer pleasure and privilege to welcome all of you to this discussion on decoding private credit in India for Mint. Without much ado, let me sort of begin the question and delve through deeper into this beautiful discussion that we have for next 1 hour. Let me touch and begin the topic. It's really the heart of all newsroom conversations right now, the COVID 19. The impact of the COVID 19 pandemic on direct lending in India has clearly highlighted the need for a better credit to GDP ratio for the market of the Indian economy. I want to understand from this August panel begin with you, Shyam, really about what is the state of the Indian lending market today. We do have a slide here showing as to how the Indian lending market compares vis-a-vis other spaces and where really we are here. Shyam?
Sorry. Yeah. The Indian credit market has been dominated by the banks and the non-bank financial companies for a long period of time. It started with primarily dominance of PSU banks. Then the private sector banks came along. Still, the credit to GDP ratio is relatively modest and low for the stage of growth of the country. As the economy develops, credit intensity would probably increase initially, and the need for credit is very much out there. The challenge is the banks and the non-banks, as you have rightly pointed out, may not be able to fulfill that requirement. And that's where the private credit demand is extremely apparent and necessary for the growth.
Neeraj, I come to you now, from BlackRock perspective and what you've observed in the markets for a long time. What really is the state of the Indian lending market today?
I think the overall credit markets in general in India are in a very nascent stage. So whether it's in terms of the the capital markets or the private credit within that lending versus opportunistic or other aspects of that. So it's still relatively nascent. And just to add one point here to what Shyam just said, obviously we see the challenges facing the banking system and the non-banking financing corps. But if you take a step back and think on the other side, we saw a big shock to we saw an elevation in terms of the fiscal deficits the countries are running. Now that this adds to the challenge, which is as we go into 2021 and fiscal year 22 in case of India, you've seen the fiscal deficit target is actually still at 6.8%, which is 300 basis points or more than 300 basis points above which it was 2 years ago. And the savings rate in India has been structurally coming down over the course of last decade from 37-38% to now close to 30. Now, what does it mean when you have to do this much of a fiscal financing? You will see some level of crowding out of the corporate sector in the capital markets. You still have very high level of dependency on the banks and the non-bank corps in terms of the credit provision, where you still see the challenges in terms of liquidity, the NPLs. So where are you going to get the credit from for growth of the economy? Because if you talked about a $3 trillion economy growing at 6 to 7%, and that's real. So nominal terms, you're talking about close to double digit. You still need credit for the system to actually support that growth. And I think there is certainly a gap which needs to be filled in order to support that, not just short term, but medium to long term growth rate in case of India. So there's certainly a gap which has to be filled.
Okay, I come down to you now, Eric and Ashish. Taking further from what Neeraj just said, there's a huge gap which certainly needs to be fulfilled. Given your experience in other developed markets, as Europe and the US, how does India really compare to those markets? Give us some on the ground sense there.
Thank you. So maybe before I start, a little bit of context, because I think it's important for the audience to understand Aries' perspective on this. So for those of you that don't know us, we actually were one of the pioneers in the US originally at this particular asset class called private debt. We launched this strategy very much at the early 2000s and then grew that team very successfully and moved to Europe in 2007, when again we started the strategy from London and then moved across Europe to build one of the leading platforms in private debt, again in that region. If we think about Asia, we actually closed, if you want, the acquisition and the partnership with SSG, one of the leading platforms in credit in the region last year, which, if you take it from a global point of view, should position us very, very well for private debt and understanding that asset class from a global point of view. Now, more specific to the question, I think when I go back to the experience that we've had both in the US and Europe, and I was recruited to very much lead that strategy in Europe, so very much part of the buildup of that market. The retrenchment of the banks was very much the catalyst. I think some of my peers here on the panel started exactly at this point. The banks traditionally have been used for monetary policies. They actually channel funding to the market, and it's been a very efficient way to do so. The problem, though, is that as market developed, some of those banks can't anymore be the right agile, if you want, transmission to the market. And we've seen this in the US in late 80s, and we've seen that in Europe following the Great Depression. So in reality, the retrenchment of the bank has created a huge gap in terms of funding in those markets. And this is where people like ourselves have been able to create a replacement product, so to speak, that will actually be very much in support of a crucial part of the economy, which is the SME market. Now, if you think again about an economy, and obviously very obvious to everybody here, but typically the large institutions, the large corporates are very well served by the banks. Those that actually start to suffer in a growing environment where the banks start to struggle is actually the SME. And the SME market actually is the dynamic and agile part of an economy. So this is where the highest need is. And when I think about how we actually developed over time, the other thought I would probably leave for everybody to think about is that we had to create a demand for the investor base. It is one thing to be able to come to a company and try to provide a solution that replaces the banking market, but the other thing is to raise money and create an investor base that is attracted to the opportunity set. And I think over a long period of time, what the private debt space has proven, at least in Europe and the US, is that this particular asset class can be very decorrelated or uncorrelated to the public market in terms of performance. It can be very stable and consistent over a long period of time, again, away from volatility, as we see in particular in the latest years around the world. It has duration, and it actually offers, I would say, cash distribution to the investors. So in the context of where we're looking allocation for a lot of alternative asset managers around the world, this has actually become a very important asset class. And when we think about Asia and looking into India, which I'm sure we'll touch on as we move to other topics here, is how do we ensure the same ecosystems gets built over time to provide the same stability of performance and return, which will then attract investor money over time based on basically demonstrating the same approach to market as we've done in US and Europe. So that is my experience, and obviously I'm sure there will be more to it as we move forward. I think you're on mute.
Sorry, you're on mute, I believe.
Yeah, Ashish, you want to sort of add to that, to what Eric just mentioned, industry developed as an important asset class over the years.
Yeah, happy to do that. Let me set the context. I think OMERS may not be a name that's very familiar to our audience. So let me just spend a minute on what we do and where we fit in. So OMERS is a $105 billion Canadian pension fund for the municipal employees of the Ontario province. We have been investing in private capital for a fairly long time. And we brought this investment capability to Asia a couple of years ago. So as of now, all of OMERS has invested about $8 billion in Asia, and we'll be going up to $20-30 billion over the next 5 years. And within that, private debt is going to be one of the key things that we do. Going back to the question around comparing, how do we think about India in the context of Asia and the world? I think US is always ahead in terms of development, financial developments, financial maturity, and there are a lot of lessons to be learned from there. And we have a fairly big investment book over there, and it seems to us that's inevitable that many of those best practices will come to Asia. So when you look at Asia and India, the way we think about it is there are many kinds of capital providers, and there are many needs that capital borrowers have. And as the market deepens and develops, you have a better matching process. In India at the moment, you have few providers of capital and lots of needs. So as you have the private debt capital process and providers develop, I think there'll be more ability for people to access this kind of capital, which is all often solution oriented. You have the traditional banks providing, whether it's working capital or some degree of project finance, and NBFC playing a different role. But a lot of the private capital providers do is give you flexible capital, give you speedy decisions, and in a way complete the ecosystem of capital providers. So it's inevitable that this will grow. It'll grow quite rapidly. It'll grow faster than the banking system will. And it will play a big and important role in the capital formation of India.
Yes, I heard all of you, and I think the consensus sort of evolving really is that there's huge unmet demand. This asset class has huge opportunity for growth, And the question is that where do we really grow from here? And I think we will sort of cover these aspects in the next questions that we have. I think taking it further from the COVID-19 question, I want to understand from all of you that we have about $290 billion of dry powder globally when you talk about private credit, really. And the kind of battered economy that we have seen in the aftermath of COVID 19, one question that sort of really comes in the mind is that can this really, the private credit pool, prove to be the panacea for some of the ills of India's economy today? And where is this capital really coming from? What are the advantages of borrowing from a private lender, especially in today's challenging economic environment? I mean, the color of the money really is green. You sort of take it from private lender, from private equity investor, or from private credit player. I want to understand from you, Neeraj, that what really, where does the private credit advantage, or so to say, that place comes in the ecosystem?
Sure. So I think going back to the point I touched on briefly earlier, when you think about any economy and any corporate capital base, there are only two asset classes in the end. It's equity and credit, and it's then can be in public or a private format. Now, India, just given the history, a lot of that provision of credit specifically has always been driven by banks in the last 75 years since independence, and then it over the last 10 or 15 years, we saw the growth in the NBFC market. Now, over the last couple of years, as we have seen the constraints facing or the challenges facing both of these sectors, and the lack of developed capital markets in case of especially the debt capital markets, I think there is a need for that credit. Now, there is that demand is very obvious, as especially the economy comes back, starts to grow again. You will need more credit for growth capital. You need credit for refinancings, and you need continued the recycling of the capital in the system. So I think that will continue. Again, there are different benefits from a borrower perspective. I think from a corporate side, it's relatively simple. Something that Ashish touched on, which is if you are a CFO or you're a business owner, you need to think about different sources of capital. You need to diversify those sources. You need to optimize. It's not just a cost minimizing exercise. And having that diversification of your sources, understanding the term structure of debt and how you manage that, I think becomes more and more important. And you will see that developing as the companies become more sophisticated, then they understand the value of the flexible capital solutions rather than the old style bank lending. And I think this is something which obviously will evolve, but certainly will keep growing. Now, in addition to the fact that for a lot of global investors, and the point you touched on with regards to the dry powder, India does have a benefit here in terms of the regulations, which are well understood. The fact that you have a lot of global investors who have been actually participating in the India growth story, but more through equities. So they do understand the lay of the land. They understand the regulations, maybe not as involved on the credit side. Now, given the attractiveness of the asset class today in India, I think you see from an investor perspective, taking a closer look at India and try to think of how it fits into a global private credit portfolio and not just a global portfolio in terms of the equity investment. So you do see that relative value, and I think you can look at the numbers, whether it's in the simpler senior lending all the way to structured credit and then distress. When you look at today in the world we live in, where income is really hard to find, you are picking up 300 to 500 basis points of a risk premium, and if you know, which makes it quite interesting. So there is a case for the investors from a global perspective to look at India. There's a very strong case for the borrowers given the real shortage of capital and more specifically credit. And I think it's more a question of now channelizing some of that capital in an effective way where I think the government can play a role.
That's sort of well said. I sort of come to you now, Shyam. We just heard from Neeraj that there is a win-win situation from both the parties. Investors increasingly are looking to see how does the Indian private credit piece sits in the global private credit portfolio, and of course there's huge unmet demand from the borrower's perspective also because there's flexible capital provided. I want to understand from your experiences here that what really are you seeing in the market? Give us some on the ground sense here.
So I think taking what Neeraj said on the flexibility also emanates from the regulated players which have been dominating the market for a long time, whether it is a bank or a non-bank. One is regulated, second is leveraged. And the leverage platforms have certain constraints, which was shown when the ILFS happened in terms of whether it is ALM or it is provisioning norms. Flexibility is available in terms of speed. Flexibility is also available in terms of crafting a solution which is meeting the need of the borrower at that point in time. It could be for capital formation, it could be for M&A, which is an area which is quite constrained in terms of financing from the traditional sector in India. Third is real estate. Fourth is intangibles. A lot of these are also sectors which are kind of at the building block of the country, especially real estate, which do not get adequate, I would say, attention from the banking sector. So coming to on the ground, exactly what you would expect. Certain sectors have more need, but it seems like the need has grown rapidly, at least in terms of our inward inquiries, primarily because of constraints, especially at this point in time where the banking sector is running a double-digit NPL ratios. There has been also certain comforts for the investors from the global perspective, which is there is a IBC process in place. There is a creditor protection which is increasing and improving over time. Of course, the access to the market still remains open, improving, but still a lot could be done, as Neeraj has also pointed out, in form of access, which is only available to the foreign participant in form of either an ECB in dollar terms or an rupee bond market, which has certain nuances and constraints at this point. However, still, it is pretty encouraging to see the signs that it has been opening up in the last decade or so.
Okay, Shyam, so from what you have told me, I understand that there have been increase in inbound queries that you mentioned from the promoter's perspective. So are you telling me that the case for private credit as flexible capital solution, especially in India, is well established now and it's not necessarily a difficult sell?
From the demand perspective, it is not, because there is a obviously global way of looking at demand, which is the credit penetration, which we talked about. But more importantly, the inward inquiry, which I'm sure some of our other panelists here would have seen, it has been increasing from 2017 onward, dramatically.
Okay. Eric, would you want to add to that? I mean, what really are you seeing the trend, especially in a post-COVID world now?
I mean, I agree with the panelist here. There's only one way to bridge the gap, as we explained earlier, is to bring that form of capital to these markets. The only thing I would just mention, though, is that I mentioned earlier that one part is delivering the solution to the customer, the other part is raising the capital and bridging that gap. It's very important to retain that concept because at the end of the day, the investor wants certainty of return and stability. You can only do this if the way you go about this market is predictable. So just let me give you a little bit more into this. So if you go back into US and Europe, most of the direct lenders today are only focused on this particular asset class. So they will go to the market with a very, very extensive team of originators, and they work very much in partnerships with the corporate world. So we've, for example, both in Europe and US, we've recruited very large teams, and they've been in those markets for a long period of time. They know each particular sector very well. They know each corporate very well, and they're able, therefore, to get into a dialogue very much at a particular juncture of the company that needs capital to accelerate on their growth. And there's a very intelligent type of conversation that happens at that moment. And you create a solution around that, something that is working for the corporate, which is tailored to their objectives, but is priced in such a way that you feel you actually cover your risk and you protect yourself. And that alignment of interest is very, very important. In US and Europe, we have the ability to rely on the private equity world as well to give us a little bit of if you want, sophisticated partner, so to speak, to work in that investment world. They would obviously be a good custodian of the capital of those companies. They have a particular growth trajectory over 3 to 5 years, and they align with us in terms of helping them to reach that objective. and creating an exit option for us. Like basically paying us back as the company moves to its new journey. And I think that alignment of interest is very important when we think as well about development of private debt. The third aspect I would just mention about consistency is that it's important that you're able to be comfortable about the default potential of a company and its loss once that default has happened. And I mentioned earlier that consistency of return, it's actually a lot based on this aspect. And therefore, when we look at the Indian market, one aspect that will be an accelerator of private debt is the ability to have that transparency of due diligence with a particular corporate and ultimately structure a deal where if there is a default, there is enough of a framework to be able to work through that default, find a solution, and ultimately get a resolution very rapidly where the outcome is predictable. And that is what our investors are looking to invest into. That's our duty as a manager to be able to create that opportunity set and consistently deliver upon. And once you've established these, obviously the investors around the world would like and would embrace, if you want, the opportunity set in a huge way. So that's basically maybe what I would add to it. So when we think about 290 or the number that you mentioned earlier of dry powder, ultimately that amount of money is looking for opportunities. The investors want to allocate to the asset class, and it's for the Indian economy and infrastructure and regulators to basically work towards creating the ecosystem so people like ourselves and my peers here could actually go in the market and create those opportunities and be a solution provider to the economy.
So that's a segue to my next question, Eric, to what just you mentioned right now. We recently had the budget, which essentially is the annual financial statement of the country. And the newly announced budgetary plans were designed to sell existing infrastructure to help fund new projects and attract international capital to support such efforts, sparked more interest from international capital owners to invest in the Indian recovery story. I want to understand here from this August panel that, what are the structural or the regulatory reforms really needed, which could implement to further deepen, say, the debt market, the bond market, and amplify the credit to GDP ratio in India, which essentially is being seen as a huge drag. And the second part of that question, the subsector really is that, India is also mulling a new development financial institution. And what should be the playbook for that to avoid mistakes done by the earlier DFIs? Given we have Neeraj and Ashish, both from a global perspective, I would sort of like to begin with you, Neeraj, and get on to you, Ashish.
Sure. So on the first point with regards to the deepening of the bond markets, and I think this has been something in the discussions for a long time, including the idea of opening up of the bond markets, which also has been debated, I think, time idea. The key here is when you think about the role of the government and the regulators, in my view, the most important is to create a conducive environment, have the right regulations, tax and legal structure, and then let the market participants, both the buy side and the sell side, where they can obviously create incentive structures to attract more, and help them develop the markets, the bond markets, and more specifically the credit markets. And this is critical because no matter where you look at in the world, you will see a level of correlation in terms of the allocation of capital, the pricing of risk, and the development of an economy linked to the depth of the capital markets. And I think this is something which remains an agenda item, but I would say there's still more to be done in terms of the aspect, specifically from a global investor perspective, to get more global investors to come into the market. So I think that's the first part. The second, DFIs, I think this is an interesting area of discussion. I do believe, obviously, as you would know, the history of DFIs in India goes back to 1948. So this is not new. And there was changes that happened back in 95 after they had some changes in regulations on the SLR bond treatment. So you do see a history of these DFIs in India. I do think you have the necessity at this point, especially given the fact that India needs a lot of infrastructure financing, and given the challenges facing that area with regards to the availability of capital and the ability to attract capital, I think the near-term fix is to have the DFIs, whether it's in terms of credit enhancement or even just funding of some projects, and then finding ways to attract more capital, whether you do it through transferring some of the operating assets to the private side, and the DFIs keep supporting the investment in greenfield. But I think the bigger question I'll ask is, why do we need that? Why can't we have, like a lot of other countries in this world, why can't we have the direct attraction of capital coming into the greenfield projects when you talk about infrastructure? And I think that's where having out of those 7,500 infrastructure projects that we are talking about, having some clarity in terms of what are the bankable projects, how do we avoid delays, because that's one of the issues that India faces time and again when it comes to infrastructure and long-term projects. How do we create predictability of the timing of the cash flows? And then lastly, how do we create an environment in terms of tax, legal, and creditor, or in fact, investor protection framework to be actually effective? Now, if you have the basic ingredients in place, I'm not sure you would need DFIs in that case. You would obviously be able to attract capital if it makes sense. So I think there's certainly a need in the near term. You can see that, but longer term, rather than hitting on the symptoms, it probably is better to go to the root cause and solve that. And I think that's going to be something more important for the government to focus on in the years to come.
Okay. Ashish, do you want to add to that? And that just sort of raised a very important question that, what really is the need for a DFI, after all? Why can't we invite investors sort of directly on some of the greenfield projects? I sort of want to get your perspective on that first, and then perhaps get Eric also to contribute from a global institutional perspective. What is he seeing? How can we channelize more capital to India in private credit? Yeah.
Certainly. I think, one thing, we are asset owners and we invest in not just in private credit, but in direct infrastructure assets. We already own a bunch of roads in India. We continue to look at a lot of, the private capital going into various infrastructure projects. We'd be interested and we'd be investing over there. So we look at the entire capital stack, whether it's equity, debt, all sorts of things we can do. I think Neeraj's points are very well made in terms of, there's a comment that I hear often in the industry that return on time invested for Indian investments is very, very low. And that's because of the inefficiencies of the market and the underdevelopment of the ecosystem. The more developed the ecosystem is, the more consistency there is in policy, whether it's around tax or legal or enforcement rights. The frictional costs will keep going down. The effort required, which is quite high today compared to other markets, of doing business in India will go down, and the cost of capital will go down. So not just the availability of capital, but also the cost of capital go down. It's a win-win for everybody. The frictional costs that exist today benefits no one. I mean, as investors, we don't like it. As borrowers, you're paying an extra cost for it, so you have no benefit. So there is a medium-term opportunity, which is quite large, to make sure that there's a lot of thought given to rules and regulations, and they're stable over long periods of time and not changed frequently or often. And they continue to develop the ecosystem. If you take a small example like the ratings in India, domestic ratings don't compare well with international ratings. That ecosystem has not developed. That would be very helpful. The due diligence that we have to do today, it's not as easy to do in India as it would be in some other markets. So there's another scope for development over there. And once you do this, the role for additional financial institutions or other players diminishes, because the private sector has, as you yourself said, there's plenty of capital. India is a destination for a lot of us as investors. India is a core market. We'd love to be there. We'd love to do more, and help facilitate that, and then you won't need more institutions.
Okay, that's sort of well said, Ashish. I come to you now, Eric. That I want to understand this. That there's huge amount of dry powder globally talking about private credit. There's huge unmet demand. Really, there's a case for private credit. It's not necessarily a difficult sell in the market right now. Also, increasingly corporate in India is understanding the benefits of its flexible capital. So why aren't we seeing an avalanche of private credit coming into India as we see for private equity? What is holding it back? And what can perhaps the government do to bolster steps in that direction? Eric, from an institutional investor perspective, give us some sense there.
So maybe the best way to answer this is to understand it from an investor's point of view. So I'm not obviously an investor pension fund myself, but I talk to many pension funds. And I think when they have to make a choice of this type of allocation, they do have to measure or compare different type of opportunities that they could invest into. So if we were therefore to look at the private debt space today, one of the questions they would have is private debt in the US today, if I actually have 2 or 3 very active managers, could allow me to return X amount for a risk which I can track over a number of years. And therefore, risk adjusted, my return will be, say, 6 to 8 or 9% or 10%, a number. I can do the same exercise in Europe. I compare and I say, okay, from a perspective of allocation, they're fairly similar. There's a currency obviously mix in this, but there's a diversification in terms of geography. And then I go into Asia. And then I want to understand what is the difference in terms of risk I'm taking there. And therefore, what is the return I should expect from that risk? And does it make sense in my allocation? Does it actually come into a private debt space, or is it actually more of a private equity space, or is it something in between? So it is our role as managers, as well as the peers here on the panel, to really spend a lot of time to explain, educate, and show that the risk of India and the return you can get from that risk is appropriate for a particular allocation. And that is really the big effort here. And very often you have to demonstrate this by creating a track record. You have people on the ground, they start to invest, they start to show that it works, they show return after return consistency, then the investors understand it, then they actually buy into the prospect, of that asset class, and then you raise larger funds and you bring more money. So it's unfortunately a bit of a long process. People like ourselves, whether it's, as well, BlackRock or others, are very used to that education process around the world, but we do have to go through that path. And I suppose from an Indian ecosystem perspective, again, a lot of things have been said, but it's the same answer, which is the less friction we create, the more transparency we have, then obviously it's easier for people like ourselves to create that consistency and raise more capital over time.
So essentially, less friction and more ease of doing business for foreign investors. Actually, are the 2 growing demands for institutional investors that I see emerging here. I think I want to also understand from this panel really here that we spoke about returns and consistency in returns. So what really is the playbook for that? Indian banking system is saddled with huge NPAs and huge bad loans. So what is to say that the private credit player perhaps would do a better job at this? And what really, when you compare that to a banker, how does that differentiate? Shyam, you want to take that up, and I can just go to other panelists too.
I think if you take a step back, the bank NPL is also one number, but if you do the distinction between the private sector banks and the public sector bank, the skew is very much apparent. And there is a reason for it. There is a policy transmission requirements. There are other priorities that and impositions that some public sector banks have to do. And that has ultimately not done justice in terms of credit formation, credit penetration, and has left some of the banks saddled with a reasonably high NPL. And the government, unfortunately, then have to provide that equity capital to bail them out at a reasonable frequency. On the other hand, the private sector banks have done a reasonably better job. And that is visible in the way the NPL have been managed, in the way the credit growth has happened, and ultimately in the way the equity has shown in terms of performance over 2 decades. So we're not talking about 2 years, 5 years, 2 decade period. So there is possibility to do it. There is an example it has been done. So I would like to say that that consistency that we are talking about is possible, but it takes time to grow that. And the transmission loss for a foreign player, the transition and the transmission losses are higher, whether it is taxation, whether it is ability to put money in the time frame, in the manner, and the instruments that are possible and available are restrictive. And therefore, it will take longer if unless the infrastructure also allows that to happen faster to show that demonstrated track record of consistency. But it is definitely possible and has been demonstrated by the private sector banks.
Okay, so there is a private sort of example to follow as we're seeing in the public sector, private sector comparison. I want to sort of come down to you now, Neeraj, to understand. We talk about the larger private capital space. Do we see differentiation sort of established very clearly, So there are different private equity firms and they have their modes clearly established. We will look at tech, we will look at late stage tech, we will look at venture, we will look at, pension funds, we'll look at, long-term annuity income. I want to understand that, talking about differentiation about one firm different from the other, ultimately the color of the money is green, What are the different opportunity sets that each one of you see when you talk about the private credit market in India?
Right. So I think maybe just making one point that on the question you asked Shyam in terms of why there's a difference, I would say if you want to find any difference in the world when it comes to organizations, look at the incentive structures. Incentive structures drive behavior and they drive the outcome. So we can look through and say what you see differently. Now, for us, obviously, one very basic principle is the whole concept of the disintermediation of the banking system, which obviously started primarily by more driven by regulations. It's getting accelerated because of the COVID shock, as well as the NPLs in the system. I think the idea is not to compete with banks. So when we are looking at these markets, and the simplest way I can describe is that we look at the footsteps of the banks in any of these countries in Asia, and we try to look at the gaps they are leaving behind that we want to fill. And even within that, we pick and choose. So there's a very different way of thinking in terms of the credit creation. We're not doing 100 loans every week or every month. We don't have quotas that way. We do obviously a very different approach of investing for generating returns. And we have only one source of return, and that's pricing the credit risk appropriately. We don't have 5 other sources of relationship banking and IPO and other things. So there's one source of return. You have to get it right. You mess it up, there's no way to fix it. So that's one part. The second is when you think from an organization. Now, there are 2 ways to think of it in terms of the region, and then within that, India. You have a fairly diverse region when you think about Asia. Now, a lot of people look at Asia as a regional platform. So you can create a matrix, even within privates, of the countries where you focus. So it can be India, China, Southeast Asia, Australia. And then the other part of the matrix is your strategy from the standpoint of the risk return, which is you do simple senior lending versus opportunistic structured credit solutions or special sits and distress and NPLs. Now, where you focus is a function of your mandate. So for us, in fact, I always say my job is very simple. We are a fiduciary. We do what our clients want us to do. So the mandate defines to some extent where we focus. So our focus in India specifically has been more around the senior lending and the opportunistic credit, and less so in terms of the distress and the NPL space. That doesn't mean that space is not interesting. It's more to do with the fact that this is what our investors have told us, and there is basically that defines to some extent what we focus on. Interestingly, India is one of the markets, when you look at all the discussion and just reflect on that for a minute, the level of credit gap is just humongous. It's not possible for 1, 2, or 5 or 10 private lending platforms to actually fill that gap. And it's almost to an extent, when you think about credit markets in India and you look at it as a credit investor, you feel like a kid in a candy store. And you look around and say, you have so many different flavors. but you have to pick and choose where you focus. Then that's sometimes based on your capability, based on obviously your assessment of risk adjusted returns. But I think the opportunity is pretty broad based.
Okay, I sort of come to you now, Ashish, in terms of opportunity. We just heard from Neeraj, sort of what is attractive and appealing to their investors. What is sort of appealing to you in terms of specific opportunities set for India? And I'll come on to Eric and then Shyam.
Sure. So we are a bit unusual in the sense, we do everything. So we invest in public equity, we invest in public credit, we invest in private credit. We also have three different arms which do private assets, so private equity, infrastructure asset, and we are also a very large property developer, and we have interest in all these areas. I think I mentioned earlier, India is a core market for us. So we're spending a lot of time and energy on studying the market, getting involved in different asset classes. Specifically within private credit, we see the huge gap and huge opportunity. As Neeraj was saying, a kid in a candy store, there's a lot that can be done. For the time being, there's a little bit of a difference between us and what Ares does, which they do really well. I mean, they're leaders in what they do, and what BlackRock does. They're asset managers. We are asset owners, so the money is ours, and we have a very long horizon. So the fund that we are managing, this fund has a lifespan of at least 80 years, if not more. So the firm has a tendency of thinking in decades. My CEO is quite fond of saying that a quarter should be 25 years. So the thinking is very long term. What that translates to is, for us, we rather have a relationship than be focused on a transaction. So when we get involved with a counterparty, we say, what can we do together? Whether it's debt or equity or all sorts of partnerships, what can we do together for the next 10 years, 20 years? And that's a conversation which not a lot of people can have. And we can do that with a very large size checkbook. So we are not constrained for capital. We have plenty to deploy. We want to bring that capital to Asia. So we see India from a slightly different lens, and the lens is of cautious optimism. The caution being around all the other things I said earlier. Optimism because we think that over 5, 10, 20 years, India is going to grow. There will be hiccups along the way, but we fundamentally feel we're quite positive about India. We think there's a huge gap between capital formation and provision of capital, and we can plug that gap in a thoughtful and meaningful way. So that's how we see it in a very broad sense. Within private capital, private debt, at the moment, we are also focused on performing debt. We're not getting into distressed or restructuring kind of debt as yet. That might come later. We've just been in Asia for a couple of years from our Singapore office. And as we spend more time and build up the team and make more investments, we look at other opportunities.
Eric?
So not very different from my peers here. India is a very, very important part of our strategy. For the same reasons that were put forward earlier. It is a growing economy. It is a very young economy. It is obviously an infrastructure that will seek to modernize over time and will need capital. And I do think that, and I hope you heard that from me many times, but we take a solution view on those markets. If we can provide a solution, whether it's equity, whether it's debt, whether it's real estate, whether it's corporate, and we can scale it over time for our investors and make it consistent in terms of return, we will be there. We'll invest in the people, and we'll make it a very important focus of our franchise. And having said that, we've actually been in India for a long period of time. And Shyam will spend some time on this. We already have infrastructure people, and we've actually transacted many times over many years. So we are already, I would say, a very active player in the market. But we see a big future ahead. And the speed of that future will be very much dependent on everything we talked about earlier, which will be very much dependent, therefore, on the speed of India's ecosystem itself moving. And I would say one thing which is very important, because it was underlined earlier, but I just want to re-underline it. To be able to create that space, one particular party on its own can't do it. I think there will be a need for multiple partners to invest in that market and create, if you want, that opportunity set in scale. And therefore, having some of our peers here on the panel and some of us that we talked to on many times and see how we can share information, understand this market, push and advise different regulators, partners, stakeholders to basically contribute to the opening of that market is as well part of our role. And we see that as well as a contribution we could all make going forward to India and its development. And the last part I would just say is at the end of the day, it is actually not an easy process to put in place to invest over a long period of time. It requires a huge amount of resources, a huge amount of people and commitment. And therefore, certain platforms will need to commit longer term. I think coming in and out is probably not going to be a solution, as we've seen in many of those countries. And we are definitely in that first camp, very much kind of committed to build over time.
Okay, Shyam.
No, I think most of it is already covered. Specifically, all I can tell is what we have done is right from, I would say, providing solution to the non-banks who have performing loan portfolios but have liquidity requirements so that they can recycle the capital to the right objective that they are being asked to cater to as per their shareholders. Two, providing corporate solutions to companies which are kind of unable to raise that capital from the bank in the period of time that they need, and tied over certain requirements, whether it is demergers, capital market activities, and those events that then allow them back to access the bank and more longer term capital. Two, even we have done in retail, where some of the NBFCs have to recycle their retail portfolio, which we have been able to help them with solutions. So it spans pretty much the whole gamut of activities, and I'm sure the same is true for our peers. I think it's about solution, and so far that problem is still very wide and open, and no one is going to doubt that. There is excitement and optimism from our side as well.
I think it's been a very meaningful discussion with all of you gentlemen, sort of unraveling various aspects of private credit and bringing such huge experiences of the West to the table. Extremely beneficial for our readers and watchers here. But before I dive deep into audience questions, I'll do a bit of a rapid fire. So basically, a quick fun segment, and I want like very quick answers. And Neeraj, I'll sort of start with you and then get on to the other panelists. If suppose you are stuck in an elevator with Madam Finance Minister and you have to do a 2-minute elevator pitch to Madam on channelizing more foreign capital to India, how will your pitch begin? Start.
Great. I think the time has come for India to really open up the capital markets, move for a full-blown capital reforms. I think we have not seen the kind of reforms we saw back in 1991 again. And I think the time is changing. India is one of the very few investment-grade economies which actually still has a closed debt capital market. So if you think about the need for income, which is very profound in the developed markets, and the path for that capital to make its way to India, I think India has to open up a lot more from here and do more reforms in the capital market side. So I think it's time now.
Okay. I hope she is impressed and she sort of listens to you. And I think my next question is that, what really is driving Indian markets post-COVID? What is the first word that comes to your mind? Fundamentals or FOMO?
So for equity markets, I think it is a lot to do with liquidity and to some extent FOMO. I think the fundamentals are still also playing a role, but you do see the hiding behind the defensive and the quality names and the growth names, which obviously continue to get more expensive. So it's not in terms of the run-up of the market, and the index doesn't tell you the full story.
Okay. Ashish, I come to you now. My same question to you. Your advice to Madam Finance Minister on how to channelize more foreign capital to India. What would that really be?
I would say two things. One is, India should have more confidence in India. and be willing to open up more quickly than people seem to want to or is planned. And the second thing is there's a fear of the discipline international investors might bring if the markets opened up. I would say that discipline would be good. So don't have to be worried about it. Impose that discipline. Let market forces play a bigger role.
Okay. What has been your most humbling experience in COVID till now?
Oh, not sure about humbling, but I spent 2 weeks in quarantine, which is a Singapore-style quarantine, locked up in a hotel room, which I was not allowed to leave. And that was a very introspective 2 weeks.
Okay, I come to you now, Eric. Your sort of pitch to Madam FM, what would that be? Elevator pitch, and I give you 1 minute for that.
I think I would probably go the same way as the others, really. I think India is one of the high growth potential globally, with obviously a lot of investment needed. And being able to crystallize that investment from a domestic market is just not going to be enough. They need external capital, they need external expertise, and as long as they give the right control around it, I think they should open up and make it happen so they will accelerate their growth.
Okay, and what are you watching on Netflix these days?
Actually, there's a series called New Amsterdam, which is about a hospital. And my wife and I actually love this series.
Okay, Shyam, my sort of finale question to you really is that the question I asked to Neeraj is that what is driving Indian markets really? Is it fundamentals or FOMO? What would you say?
I would not comment on the equity world.
Okay, and if you were to pitch to Madam Finance Minister for deepening the Indian financial markets, what would that really be?
It will be very simple. The MRP is for non-sophisticated consumer. We don't need to cap the return on ECBs. Let the market define what they are willing to pay and what people are willing to accept. So we have sophisticated sets of borrowers and investors. They can figure it out.
Has the deal flow increased post-COVID?
Absolutely.
Okay, and as competition increases, what will give in first, interest rates or covenants?
I don't agree the competition will increase.
Okay, and I think this is an open question to this panel here. That do you really agree that private credit funds will surpass private equity? Is the answer never? Is it 2025 or 2030?
I would pick 2025 and for sure.
Neeraj?
I think I would go with 2030 or somewhere between 25 and 30, and more looking at it mathematically in terms of the growth. But just taking a step back and think about the world you live in, where you have a lower growth potential and a real need for income when half of the fixed income assets don't give you yield. So the assets have to move, obviously, or people have to rethink about their portfolios. So I do think that shift will keep happening. But given the difference between how established private equity as an industry is versus private credit, I think it's going to still be a longer run within a few years.
Okay, so we have two questions from audiences. I will begin with the first question. What does the current pandemic mean to the industry? Is there any change in your engagement model with your investees? Who would want to take a stab at that?
I'm happy to go first. I mean, in the few transactions that we've been involved with, the dislocation has meant that people need more forbearance or rethink of when they can repay or when they want to repay. And we provide flexible capital. We are not hung up about time horizons. We have long-term time horizons. As long as the structure makes sense, as the governance makes sense. I think you mentioned covenants earlier. I think Asia is very far from going covenant light. I agree with Shyam. I think the supply of capital will increase, but the demand is growing faster than supply of capital. So I don't think we are anytime close to seeing light governance. It's still a banking-led market, and this intermediation is going to take decades. And in the meanwhile, private credit will grow fast. And in the very near term, the dislocation we saw from COVID has just meant that we've had to work very closely with the borrowers to make sure that things are structured properly.
Which is, by the way, maybe so to add to this, because this is an important point. This is one actually of the great strength of this business model. If you work with your corporate customer, client, partner, and you spend time to understand their market, their positioning, their strengths, their business plan, the cash flow projection, and you then structure a solution that basically allows them to grow, they should feel very comfortable that every time there is a problem, and COVID obviously was a very, very important one, they could come to you, explain to you what the problem is. You can easily re-underwrite their growth, understand that they need some time, because as a natural partner, you've gone deep into that relationship. You've actually really done the search, you've done the work, and you can be very agile in terms of restructuring that particular piece so it allows the company to go through this issue. Now, obviously, there is another counterpart of that, which means that we might have to increase the return for us to be able to compensate for additional risk. And I think that's the quid pro quo, which we'll have to work with. But then if the company goes back to a normal type of, I suppose, world, and as we all hope to achieve soon, then obviously this will all be coming back to a normal rate. And I think with that agility of pricing the risk, structural flex, because we understand that customer very well, we do think that direct lending has a real big role to play, in particular during those difficult moments.
Okay. And the second question is there any role of ESG in private credit?
Absolutely.
Absolutely. I think there's a role for ESG in all investing. So if you think about one of the biggest trends that has gotten accelerated in some way, the future is running at us, if you look at that, is ESG. And I think that's going to become more and more important. And as you think about that from an emerging economy standpoint like India, I do expect that there will be businesses, industries, business models that will actually leapfrog towards that. So the trend is very clear. So I think it's going to go into all forms of investing.
And I think
Okay.
just to give you a perspective as well on this, we've moved now from a model in Europe and US where we select a borrower, for example, to take credit that has the right ESG construct to actually a borrower that does have it, but then will be able to work with us to even improve it over time. So there is almost a value add layer that we bring to our partners or borrower partners who say, okay, from everything that we've learned around the world and through our franchise, we would like to work with you to put a plan in place over the next 3 to 5 years to improve on your ESG credentials. And that's something that you're seeing more and more from people like ourselves as we look into investments.
Okay. There's another question, but I'm not sure if you've already answered that, is that post-investment, how do you monitor your portfolio companies? How does this differ from traditional VCs or debt from banks?
Very, very closely.
So asset management, I think, is an integral part of credit underwriting and disbursement. And it is a lot more closer, a lot more in tune and sync with the needs and the environments that the corporates or the borrowers are operating in. I think it's a lot more focused. And again, Neeraj pointed out, the incentive drives behavior, and the asset management is very well rewarded and valued in our firms.
Okay. Thank you, gentlemen, for sharing these meaningful insights with us. I think we have so much interest from our audiences, and I think we're doing a second dispatch on the 17th on this sort of series of decoding private credit in India. Till the time we see you next, goodbye and good luck. And thank you, gentlemen, for putting your time and energy to this. Thank you so much.
Thank you.
Thank you.